Coming up on the program, Nigeria's total capital importation in the first quarter of the year rises by 53.97%. South Africa's Tiger Brands eyes significant job cuts on coronavirus. And Barrick's Tanzania gold concentrate containers cleared for export. Hello and welcome to Business Incorporated. I'm Chimeze Obi Iwagu, and we'll tee off with a report on capital importation into Nigeria, which stood at $5.9 billion in the first quarter of 2020. This represents an increase of 53.97% compared to fourth quarter of 2019 and 31.19% decrease compared to the first quarter of 2019. According to the data released by the National Bureau of Statistics, the largest amount of capital importation by type was received through portfolio investment, which accounted for 73.61% of total capital importation, followed by other investment, which accounted for 22.73% of total capital, and then foreign direct investment, which accounted for 3.66% of total capital imported in first quarter of 2020. By sector, capital importation by banking dominated first quarter 2020, reaching $2.9 billion. The United Kingdom emerged as the top source of capital investment in Nigeria in the first quarter of 2020 with $2.90 billion. By destination of investment, Lagos State emerged as the top destination of capital investment in Nigeria in the first quarter of 2020. This accounted for 87.72% of the total capital inflow in the first quarter. Let's get some market numbers now. The Eid holiday continues today for some of the markets we track here. Only the market in South Africa is trading, and the index gained 0.64% at intraday. Other markets were closed for the Eid holiday. Nigeria's index closed positive by 1.80% on Friday, while Egypt's market closed negative on Thursday. Kenya closed positive on Friday. And markets in the Gulf region also remained closed for the Eid holidays, but closed the week mostly positive on Thursday. Dubai's index was up 0.28%, as Emirates MBD Bank gained 0.6%, while Dubai Financial Market rose 2.7% after its quarterly profit jumped 23.5%. On the flip side, Abu Dhabi's index was the sole loser by 0.43%. Elsewhere in the region, the Qatari index rose 0.19%, while Saudi Arabia's index was flat at 0.01%. And in the UK, stock markets are back in action today after being closed for the bank holiday on Monday. And of course, a number of data and corporate news out there as well. Juliana will take us through that. Hello, Juliana. Good afternoon. Well, the CBI retail survey released this morning shows that retail sales volumes remained deeply depressed. Are the markets reading those data as well?
Good afternoon, Chimeze. In short, no. The FTSE started with triple-digit sentiment this morning, and that's because possibly it's a shorter week, but I think it's got more to do with Prime Minister Boris Johnson yesterday announcing that Britain is once again open for business, although it won't be until the 15th of June when we can start seeing those non-essential shops reopening. At least there's some resurgence and optimism that things could finally be turned around. The All-Share intraday is up 1.56%. The FTSE 100 is up by 1.26%, and the FTSE 250 is up by a massive 3%. In currencies, the pound is up on the US dollar by 0.99%, up on the euro by 0.46%, and up on the Japanese yen by 0.96%. You mentioned the CBI and the retail data that they got. It's pretty bad. We know that retail in this country has been suffering over the past couple of years, particularly the high street. It's just very difficult for them to try and compete with what's happening online. And of course, the lockdown hasn't helped this sentiment, because not only have people not been able to go into the shops, they've also been very comfortable spending online, and some people are not comfortable spending at all. One of the good things is that the government have, of course, been subsidising people's wages. So whereas many people who work in retail would have lost their jobs over the past couple of weeks, at least they may in fact have those jobs to go back to when these stores do open. One of the issues that the CBI have spoken about is cash flow. 86% of the 86 retailers that they spoke to said they have a really big problem with cash flow. And so there are suggestions and questions about whether or not the government will once again have to step in when retail opens its doors in a month or so.
And struggling luxury UK car maker Aston Martin has announced that Chief Executive Andy Palmer has stepped down. What motivated that move?
It's been a turbulent couple of years for Aston Martin. Luxury retail, especially luxury cars, of course, you can imagine they're only really for the 1% that can afford them, and they have just not been spending their money on Aston Martin over the past couple of months. When it comes to Dr. Andy Palmer, it was particularly what happened in Q1 of this year. The company reported about £180 million of profit loss, and that was before tax. And since the start of them being on the FTSE 100, where shares were about £19 per share, they've dropped by a massive 90%. And now you can get a share in Aston Martin for as little as 34 pence. They released a statement and they said that it was a mutual agreement. Andy Palmer has been at Aston Martin for about 6 years. Before that, he was at Nissan. He was the COO and the CPO at one time. So I'm sure he's going to go on to get another fantastic job. But for Aston Martin, they think it's time to change the helm. And he will be replaced by Tobias Moers, who's currently running Mercedes AMG.
And was this fuss about Dominic Cummings driving during lockdown that even the minister, Douglas Ross, had to quit?
Gosh, a fuss. I think Dominic Cummings would like it to be a fuss, but I've got to say, Chimmy, this is probably the biggest political storm that Boris Johnson has faced since becoming Prime Minister. It's a huge story here, and it's definitely not going down lightly, and it's gaining traction. What he's been accused of doing, and what he's actually admitted doing, is at the height of the lockdown, when that stay home, stay alert message was being reverberated around the country, he tested positive for COVID-19. His wife, who's also a pretty senior figure here in Britain, she also tested positive. And what we've now found out is that they drove 264 miles to his family home in Durham with their small child. Now, Dominic Cummings has insisted that he did that because him and his wife were too ill to look after their 4-year-old son. So they needed a niece who lived on the family estate to help them do so. This has not gone down well with ministers or the public at all, especially because we then found out that he took a second trip to a beauty spot 54 miles from his family home, where he sat by a river for 15 minutes. Now, this may sound like a bit of a chuckle, but in Britain it isn't, because, of course, as you know, we have the second highest death rate for COVID-19 in the entire world. People took that message so seriously that many people could not say goodbye to their loved ones, including people who were losing children under the age of 10. So it's incredibly serious. So far, Prime Minister Boris Johnson has defended him publicly twice. And there's no doubt about it that Dominic Cummings is the most senior aide in Boris Johnson's cabinet. Some people credit him for even winning the last election, as well as getting Brexit through the door. But as you said, Douglas Ross, a junior minister from Scotland, has resigned. There are several senior Tory MPs that are asking for Dominic Cummings' resignation. And just before I came into the studio, YouGov, which is a pretty reputable polling site here in the UK, 59% of the public do insist that he has got to go. So tomorrow, when Sir Keir Starmer, the very vocal, very meticulous leader of the opposition, the Labour Party, comes face to face with Boris Johnson in the dispatch box, we will expect fireworks. That's if Dominic Cummings is still in his position at that time.
I can imagine what's going on there at the Downing Street. Anyway, let's continue to keep a track on that and, of course, other developments. Thank you, Juliana. And stocks in Asia Pacific jumped today after American biotech firm Novavax said on Monday it started the first human study of its experimental coronavirus vaccine. Japanese shares led gains among major markets in the region, with the Nikkei 225 up 2.55% to close at 21,271 points. The Topix index also ended its trading day 2.17% higher at 1,534.73. Hong Kong Kong's Hang Seng Index also saw robust gains, rising 2.08% as of its final hour of trading. Mainland Chinese stocks advanced on the day, with the Shanghai Composite up 1.01% to about 2,846.55, while the Shenzhen Composite soared 2.21% to around 1,789.52. South Korea's Kospi also gained 1.76% to close at 2,029 points. Overall, the MSCI Asia ex-Japan Index rose 1.86%. And stock futures traded higher early Tuesday morning to begin a holiday-shortened week as optimism about a potential coronavirus vaccine built. Futures on the Dow Jones Industrial Average jumped 468 points, pointing to an implied opening jump of around 481 points. S&P 500 and Nasdaq 100 futures also pointed to a positive open for the index on Tuesday. Trading volumes remained thin in overnight action. U.S. markets were closed on Monday in observance of Memorial Day. American biotech company Novavax said on Monday it started the first human study of its experimental coronavirus vaccine. The moves in stock futures followed a solid week for Wall Street that saw the 30-stock Dow rise 3.3%, posting its best weekly performance since April. The S&P 500 and Nasdaq also climbed more than 3% last week. Meanwhile, investors kept an eye on the U.S.-China tensions, which showed signs of escalation over the weekend. And oil prices climbed in early trade, boosted by increasing faith in the market that producers will to stick to commitments to cut crude supply while demand picks up with more cars back on the road as coronavirus lockdowns are eased around the world. U.S. West Texas Intermediate crude futures gained 3.2% to $34.31 a barrel, just off an intraday high of $34.33. There was no WTI settlement on Monday because of the U.S. Memorial Day holiday. Brent crude futures were up nearly 1.7% to $36.12, adding to a 1.1% gain on Monday in thin holiday trading. The market was buoyed by comments from Russia reporting its oil output had nearly dropped to its target of 8.5 million barrels per day for May and June under its supply cuts deal with the Organization of the Petroleum Exporting Countries and other leading producers, a group known as OPEC+. And gold ticked higher today as brewing Sino-U.S. tensions over Hong Kong lifted demand for the safe haven metal though easing coronavirus-induced lockdown restrictions supported equities and capped billions gains. Spot gold rose 0.2% to $1,732 ounce. U.S. gold futures were down 0.1% to $1,733. Among other precious metals, palladium gained 1.1% to $2,013 per ounce. Platinum added 1.3% to $849.32, and silver rose 0.8% to $17.34. Concentrate container belonging to Barrick's Tanzania subsidiary Twiga Minerals have been cleared for export for 4 months after the government lifted an export ban imposed during a tax dispute. Barrick CEO Mark Bristow says the gold was worth $260 to $280 million. And South African food producer Tiger Brand is looking to cut significant numbers of jobs and has scrapped its interim dividend due to supply disruptions and margin pressures linked to the coronavirus. The owner of popular South African food brands Jungle Oats and Tastic Rice said its first half headline earnings per share fell 35% for the 6 months to March. Its profits will take a roughly 500 million rand hit in the second half for currency weakness, global supply chain disruptions, and additional costs incurred during a lockdown to curb the spread of the virus. The company has started looking at cost-cutting measures, including possibly significant job cuts. Tiger Brands employs more than 11,200 people in South Africa, excluding seasonal staff. And after the break, we'll take a trip to Kenya ahead of the Central Bank's Monetary Policy Committee meeting. Just stay with us. The Kenyan Central Bank's Monetary Policy Committee will hold its next rate-setting meeting on Wednesday, May 27. At its April meeting, the central bank cut its benchmark lending rate to 7% from 7.25%, saying actions to cushion the impact of the coronavirus was having an effect. But the bank needed to do more due to the adverse economic outlook. Joining me now to talk about this and more is a policy and governance expert at Sovereign Insight in Nairobi, Vincent Kimosop. Thank you very much for joining us, Vincent.
You're welcome. How are you?
Very well, thank you. Well, the Monetary Policy Committee will be meeting tomorrow for its rate-setting meeting. What do you see them doing, considering the impact of COVID-19 on the economy? At its last meeting, it cut its rate to 7% from 7.25%. Do you see any further changes?
Yes. There is a very high possibility that there will be even further reduction of the rate. And this is informed by two reasons. One is the need to ensure that the economy is stimulated because of the adverse effects that we've had from COVID-19. And then also the shrinking fiscal space. We have had proposals on the fiscal side, and including even the borrowing that we got from the IMF and the World Bank, and knowing the maturation of our debt and the opportunity to broaden the fiscal space, that is being limited. And thus, you can see the need to turn to monetary policy to see that we continue on a growth trajectory.
Now, can you paint a picture of how much impact COVID-19 has had on the Kenyan economy?
When you look at COVID, and of course this is not just isolated to Kenya, number one is that the limitation of movement. So this has directly affected jobs in the service sector, the closing down of hotels, restaurants, the closing down of Nairobi as a city to and fro, knowing that this is the place where 50 to 60% of the GDP is generated. So you don't need to be a skyrocket scientist to actually see that this has had an adverse effects. When you look at, we've had strikes recently by the transport or the drivers that transport goods across the border because of the testing regimes that you have in Kenya, in Uganda, and also Kenya and Tanzania. So in summary, the hospitality industry has been grounded to a halt. There will be need for a targeted program to revamp the hospitality sector. It contributes significantly to our GDP and also to employment. And currently, we have a shutdown in that sector.
Now, aside from monetary policy, the president also announced several fiscal policies, which include 100% tax relief for persons earning gross monthly income of up to 24,000 Kenyan shillings. Now, they also had a reduction of income tax rate, that's pay as you earn, from 30% to 25%, reduction of the value-added tax from 16% to 14%. But do you think these measures will safeguard the economy during the COVID-19 period and, of course, stimulate growth for recovery post-COVID?
I think mainly on the first part, on safeguarding, because at the moment what is needed is targeted measures to ensure that people have incomes that ensures that they're able to purchase, they're able to sustain and survive really through the season. So by the reduction of the income tax, corporate tax, the message there is ensure that there is high disposable incomes both on the hands of companies and also the hands of individuals. Remember also that we have a high dependency ratio, high unemployment among the youth. So those who are employed, the ability for them to support a significant population so that the state is also the burden for them to sustain a population is also reduced. So in terms of taking us through the process, they are not sufficient, but they are welcome. Now, last week, the president made further proposals that now you see this were targeted towards supporting certain sectors. There will be 10,000 teachers that will be employed. Of course, that means direct injection of incomes to that constituency. There is money that will be given towards youth volunteer program. Again, telling you efforts directly targeted towards ensuring people have money to spend. Now, the challenge is the adequacy of these measures compared to other African countries. It looks negligible, but it's a welcome step nonetheless.
Now, aside from COVID-19 pandemic, Kenya is one of the East African countries being threatened by locust swarms. World Bank has just released about $500 million to battle this. How bad is the situation, and will the World Bank funds help in curbing this trend?
We would want to say that knowing that we are still an agri-based economy, I had a personal experience with these swamps, locust swamps, and I would want to say that it directly really affects food security. It affects not only the agricultural sector, but also the livestock sector. So the money is not adequate considering the contribution of the two sectors into the economy. It's welcome, and also you know very well that it's a new phenomenon that even the adequacy of the measures put to curb it has not been evaluated well. But they would say that it looks like it's a drop in the ocean, but of course the ocean would be less if that drop was not put in. So I would say that there is need for even greater collaboration, because the locusts do not know borders. They are moving from Ethiopia, Somalia, and even getting to Uganda. So the challenge we're seeing now is the complementary of our efforts to combat this and also share experience and ideas.
Now, in all of these, what is your outlook for the economy?
I would say that because we are not in this alone, so it will be unfair to say that to make a broad comparison. But I would want to appreciate that there is you can see that the measures that have been put towards addressing COVID, they are not taking us to where we are supposed to be, but at least they are injecting positive messages to different sectors. There's a survey that has just been released by the private sector and businessmen on evaluating the measures that the government has taken on COVID-19, and you can see positivity. But the challenge we need to do is really look at what sectors do we put money that the multiplier effect of such investments will affect more people. Here I'm looking at people in the SME space that employ a significant population. So there is importance of raising the current investment from 55 billion to possibly 200 billion. That is like 2% of our GDP. So we look forward to seeing the combination of the monetary policy measures that will be pronounced tomorrow, together with the fiscal measures, and then also direct injection of support so that we not only survive through this season, but also we have a thriving economy that will provide opportunities to the very young people that need them.
All right, thank you. Let's just wait and see what the Monetary Policy Committee would eventually do tomorrow. Thank you, Vincent, for your time. Vincent Kimosop is a policy and governance expert at Sovereign Insight in Nairobi. And on that note, we draw the curtain on today's edition of the program. Thank you for watching. I'm Chimezi Obi Iwagu.